thanks to the organizers for inviting me to join your workshop and present this paper, Inflation Expectations and Risk Premium in Emerging Bond Markets, Evidence from Mexico, joint work with Remy Beauregard and Simon Ju. They're former RAs of mine, now in grad school, and then Eric Fischer is a former colleague here in San Francisco. He's now at the New York Fed. And these are our views and not the views of anybody at the Federal Reserve Bank of New York, the Federal Reserve Bank of San Francisco, or anybody else in the Federal Reserve System for that matter. And given that it's a workshop, and it's a workshop on macroeconomic modeling, I might have a few more technical slides than I normally would include, but the topic is still current and high level and of general interest. So I'm a term structure guy. I do yield curve modeling, and there inflation is a key risk to fixed income investors. And as we see right now, maybe economic stability more broadly. And a lot of central banks around the world, they are tasked with preserving price stability through an inflation target. And for emerging market economies where inflation risk is usually a little more volatile than what we see in many advanced economies, this might be more of a challenge than we see in advanced economies. So to provide some evidence or get some sense of that, we're going to explore the ability of the Bank of Mexico to meet its inflation target, and we're going to do that using a normal term structure model of nominal real yields that accounts for liquidity risk. And then we also study some of the output from the model is we get estimates of the Mexican inflation risk premia, and we're also going to explore what are the factors driving the variation in inflation risk premia down there south of the border here from where I'm sitting right now in the US. So whenever I use non-US data, people always ask, hey, why are you going to Mexico? Why are you going to Canada or Switzerland or whatever countries out there I've explored by now? But Mexico, that would seem to be a useful case study. I mean, it's obviously close to the US, close to US markets, so it's relevant for that. Then once you dive into the data, it turns out there are well-established markets for nominal inflation index bonds, so we can actually do the kind of exercise that I'm going to show you. And then Mexico is also representative among emerging market economies, in particular those with open capital markets. And because of that, in most emerging market, say bond indices, Mexico typically carry a weight of between 10 and 15%. So then it has a stable level of credit risk, so we might not have to be too concerned. I'm going to show you some numbers on that. So you might not have to be too concerned about, what's going on here and what's coming out of the analysis. That's just driven by variation in credit risk. Then there are no QE programs prior to 2020. So the sample the benchmark sample shouldn't be too polluted by that. So we don't have to worry about that either. There's no, in Mexico, interest rates haven't gotten even close to the zero lower bound. So there's no zero lower bound constraints, unlike what you might say in US or Canadian data. And then a little technical nerdy details. There's no deflation protection in these, not that it matters as in the current situation. We all have all too high inflation, but there has been periods where inflation has been somewhat low. Even in Mexico, but there's no deflation protection in these inflation index bonds, which again contrasts with, say, the US or Sweden or France, most of the countries out there, actually, Japan. The inflation index bonds, they actually offer protection against deflation. And when inflation is low, like in Japan, you need to account for that. We don't need to worry about that here. So that's a little laundry list about some of the nice things about Mexican data. Then The core thing I'm going to use these nominal or real yields to like zoom in on is the difference between nominal and real yields of matching maturity. And most of you have probably heard about that object called break-even inflation, and that's a widely used measure of market-based inflation compensation. But you can crank that out. You can go to Bloomberg Terminal or whatever to track down numbers on that. And then a lot of people do that, and then they look at that and they might equate that to inflation, but please don't do that, because break-even inflation reflects, yes, expected inflation, but there's also this inflation risk premium and then liquidity and other risk premium. So you really, to understand break-even, you really need to account for these different risk premiums to get to the underlying inflation expectations. And the tool one should use to do that is a dynamic term structure model of nominal and real yields that allow you to get tangible estimates of these risk premium and get to the underlying inflation expectations. So that's kind of a one slide on, at a high level, what's going on here. And in terms of the numbers, the inflation and inflation history in Mexico, here I'm plotting data back to 1990. And yes, you can see back in the 90s, what does volatile and unanchored inflation look like? And then you can see in gray, the 7 years the Bank of Mexico used to transition from a period without an inflation target and with high and volatile inflation for many various reasons I'm not going to talk about here, but you can see during those 7 years they got inflation down and stabilized, and then in 2002 the current inflation 3% inflation target was adopted, and since then inflation has been, by Mexican historical standards, inflation has been really stable and close to this target. And yes, there are papers out there, Chiquiara and co-authors, that have examined, is CPI inflation a stationary process? And it looks like they find, yes, it wasn't a stationary in the years and decades before 2002, but at some point around 2003, it looks like inflation has been fairly stable down there. Then now the question is, are inflation expectations, because this is inflation itself, a little bit different than inflation expectations themselves, and then obviously in the current situation, the last 18 months, do we start to see some evidence of unanchoring in a country like Mexico? So that's kind of the background going into this study. And then one slide that kind of summarizes our finding and the kind of results I'm going to show you. If we start with the gray line here, I focus on, in the paper, we focus on the long-term inflation expectations, so the 5-year break-even. The gray line, that's the fitted number you would get if you just go to Bloomberg Terminal or some other database with Mexican bond yields. Then our model provides estimates of the liquidity premium, both in the nominal bonds and in the inflation indexed bonds, and the net liquidity premium or net pollution, that's indicated with yellow. So you remove that, and then you get to the 5-year frictionless or adjusted break-even, shown with the solid black line. And because the model is arbitrage-free, it allows me to, there's formulas, if you do the finance math of this, that allows us to break down that solid black line into an inflation expectations component, shown with red here, the 5-year expected inflation, and then the residual 5-year inflation risk premium shown with green. And on top, the solid black line at 3%, that's the inflation target of the Bank of Mexico. And then the blue crosses, that's the consensus forecast survey, the five-year inflation forecasts from that survey. And then the last line here is the CPI inflation year over year, shown with the solid cyan color. And if you focus on the red line, the five-year expected inflation, it fluctuates a little bit, somewhat more than what we see in the surveys, but it's fluctuating at a level close to the 3% inflation target. So that's the kind of evidence that tells us or suggests that inflation expectations have actually remained throughout our sample anchored close to the 3% target. And on the other hand, most of the variation in the frictionless or adjusted break-even, that's caused by persistent swings in the inflation risk premium. And we can use the model dynamics to make projections of where's the red line likely to go going forward. And the model projections suggest that this situation is likely to continue. And I'm going to show you how those projections, the subsequent realizations and the changes we have seen the last couple of years have actually played out relatively close to the projection we get from the model. So overall, that's the kind of evidence we use to conclude that inflation expectations appear to be well anchored. But that's the kind of the composition of break-even that comes out of the joint model of nominal and real yields that I'm going to show you. So that's just the background and the main results and the main findings and the kind of the flavor of what you can do with these models. And then now, because this is a workshop and it's a workshop on modeling, there's going to be like 20 plus slides now on the more nerdy details here. We're going to talk about the Mexican bond data, some of this credit risk and liquidity premium and what to expect. Then the model framework. Then once we have spent 20 slides on all that, we can look at the results, circle back, look closer at these estimated liquidity premia, the break-even decomposition, and the more exercises about the estimated inflation expectations. And we can, at the end, make some analysis of the inflation risk premia as well before I will conclude. So that's the roadmap. But in terms of the Mexican data, and like I mentioned a couple of slides ago, once you dive into it, there are well-functioning and well-established markets for both nominal and real bonds in Mexico. So what I'm showing here is the universe of nominal bonds that we are using. And each line here is a bond. It gets issued, it starts trading, and as time goes by, it approaches maturity at which is at 0. So each line here is a bond. And you can see that the Mexican government, it issues nominal bonds fairly regularly with 30 years to maturity, with 20 years to maturity, with 10 years to maturity, 5 years, which means at any point in time, here if you go into the cross-section, there's actually a full cross-section of bond yields from the very short end up to the very long end. And that's the kind of cross-section you would like to see, because that's what my term structure models, they live on. A level, slope, and curvature. What's the level factor? What's the slope factor? What's the curvature? Yeah, to see the full cross-section of nominal yields at all times. That's what delivers the foundation of the econometric identification of the various factors in the model. And on the nominal side, we start in 2007, and we end the exercise just to avoid the COVID for the main exercise. We end that at the end of December 2019. And then you take all these bonds and take their prices and convert them into yield to maturity and plot them. Then you get this kind of pattern with changes in the level, but also in the shape. at times the yield curve, like in 2007, is flat. All yields, even from the shortest up to 30 years, is trading at close to the same yield. And then at other times, you have this sharply upward sloping yield curve, and this variation at kind of changes in the shape of the yield curve at business cycle frequency. That's the same pattern we see in US data, in Canadian data, so at a high level, this looks like yield curve data from most bond markets out there. So that's why we need level slope and curvature to model the fundamental structure of this data. And then the novel, if you want, the novel thing of this paper is because these nominal bonus yields, I have already explored that in a paper with Patrick Schulz, another former RF mine, and Eric Fischer. It was published in 2021 in Journal of International Money and Finance. So the nominal side is kind of building on this previous research. The real side of the model, that's the new thing here, because we are the first, I think, to really use these Euribonus inflation index bonds that the Mexican government is also issuing. And again, each line here is a bond, and you can see also on the inflation index side that the Mexican government has issued repeatedly 30-year Euribonus and a good chunk of 10-year Euribonus, and also some with even shorter maturities. And again, the key point here is that at each point in time, we have a full term structure of bond prices or bond yields to feed into the model, and that delivers the econometric identification of the factors. In one thing in terms of, if you go, in principle, this data should be available far back in time, but we downloaded from Bloomberg, and it's really spotty and uneven up until the middle of May 2009, and then all of a sudden, all bond series are have full data every day up to the present. So that's why we looked at the data and like, let's just start there into May 2009 when the data starts to be fully consistent, and then. But if you really want to lengthen your sample, it might be possible to use some of the data available from Bloomberg if you want a longer sample. But that's the starting point for our sample, and then again take those prices, convert them into yield to maturity, and plot the time series for each bond, and you get this pattern, and you can see. It's a little more erratic, little more systematic in the cross section, and that's like a visible sign that liquidity risk or some form of mild mispricing is potentially a notch more severe in the inflation index market than what we see on the nominal side, but otherwise. It's kind of the same. You have periods where the slope of the yield curve is very steep, and then you have periods where it becomes almost flat. And that happens at this kind of business cycle frequency. So both the nominal and real yields at a high level have followed the same patterns. But now in terms of more details on the pricing and the behavior and what to be concerned about. Once you move away from advanced countries, the first question that's thrown at you, hey, what about credit risk? And so here I'm showing the 5-year CDS rate in black, the 1-year CDS rate in gray, and then the difference between those two, which I call the CDS rate spread, that's the red line. And one thing to note here is that the 1 year CDS rate is outside of the global financial crisis, this gigantic, brief, short-lived spike there in late 2008, early 2009. This gray line is really low. So at any point in time during our sample, the near-term credit risk of the Mexican government is really low. And the spread between the 1 and the 5 year, that red line, that has a correlation of like 0.1% with the gray line. So the behavior of this 5 year CDS rate is not, doesn't speak to the idiosyncratic credit risk of Mexico. That black line, that reflects investor sentiment, global investor sentiment in the global financial markets. That has nothing to do with the credit risk of Mexico. Lastly, and probably most importantly, we are looking at break-even, the difference between nominal and real yields. So if nominal yields were impacted by credit risk and real yields were impacted by credit risk, well, when we take the difference at matching maturities, the credit risk component vanishes, it differences out. So even if I'm not buying that credit risk matters here, but even if somebody wants to be, really stubbornly academic, then I'll just say, we're studying the difference. So you can think whatever you want about credit risk, it's going to difference out in our analysis. So that's the point about credit risk. I'm very firm about that. So then there's the difference in liquidity risk across these two markets. And the Mexican Bank of Mexico, they keep track of the owners of these different and daily. So there's a database going back to the, I think, late 70s, where they report daily holdings broken down into bonus and unibonus. So here I'm plotting this data and broken down in a few different categories. And in particular, it's possible to distinguish between are the holders domestic residents or foreigners. So here I'm showing the holdings of the nominal bonds, the bonus. And you can see foreign holdings were low in 2007, and then it's just grown gradually. And by 2013, the foreign holdings surpassed. So now at the end of our sample, it's like 60% of the bonus market is owned by foreigners. This increase, that coincides with this, zero interest rate policy in the US and by many. So this is likely, reach for yield driven by the zero interest rate policies by advanced economies during this period. And we talk a little bit about that in the 2021 paper. Now for the unibonus market, it's very different. The domestic residents, that's the black line, they own the whole thing, and foreigners practically own almost nothing. It's like way less than 10%. So the dynamics of these two markets, you have one that's basically dominated by foreign investors, and then you have a market where foreigners are practically absent. This would be one reason why, say, the liquidity dynamics of these two markets could be very, very different for this reason. Lastly, I'm going to measure liquidity premia. So is there a reason to believe there's liquidity premia in this market? So what I'm plotting here is the, again, Bloomberg provides, in addition to the mid-market prices, they also provide bid-ask spreads for all the bonds. So we have the daily bid-ask spreads for all the bonds in our sample. So go in and track the universe of nominal bonus bonds and calculate the average bid-ask spread for each day. And that gives me the black line here. And then do the same for the UDI bonus and get the average bid-ask spread in our sample. That's the gray line. And you can see the two lines, they're operating at close to the same level, but they do have idiosyncratic variation. The main point is that bid-ask spreads in these markets are easily 4 or 5 basis points, whereas, say, in the US Treasury market, bid-ask spreads is like 0.2 basis points. So this is like 10, 20 times bigger than the bid-ask spreads we see in the US Treasury market. So this would be, yes, the trading frictions in this market are orders of magnitude higher than, say, in the US Treasury market. So there is a tangible reason to believe that the pricing of both bonus and UDI bonus would carry a liquidity premium. So we need to account for that to understand break-even inflation. So that's the underlying motivating data for why we need to do that. So that's what I can tell you, what I know about the Mexican bonus and UDI bonus market and the kind of data we have tracked down for this project. And let me go to the model framework and the model structure, which is the most relevant piece for, I think, given the title of your workshop here. And the key point is to measure liquidity premia. So just to introduce a few concepts and my thinking on that, well, if there are liquidity premia, then if you adjust for that, you must get to some underlying frictionless price. There must exist some pure price that a financial claim would have in the alternative, not in the world we live in, but in the alternative world where there were no frictions to its trading. And if that's true, then yes, the prices we observe, well, they're different from that frictionless, non-existing world. And the difference would be that there's some liquidity discount. The prices we serve are actually below what the financial claims would be trading at in this alternative frictionless world. And then the liquidity premium, that would be the difference between the yield we actually observe and then the lower yield that would prevail in that alternative world where there wouldn't be any frictions. And then what people have reported in the literature is typically the relative liquidity premium, say the difference between a seasoned and a new treasury. So they never really measure the underlying frictionless price. They just, oh, I have a new on-the-run security here and a matching or very similar off-the-run seasoned bond here, and then I can observe the two prices converted into yield to maturity, and then the difference, the yield difference, which is a yield spread, would be a measure of this relative liquidity premium. So that's kind of what you would find in the literature and give you some labeling and some words for how I'm thinking about these factors in our models. We will model the frictionless yield risk factors, and then we throw in on top separate factors to account for the liquidity of bonus and UDI bonus. So that's, and if anybody in the audience have questions along the way, feel free to jump in at any point if there's something that's not clear. So just to set the stage, the starting point, standard assumptions in finance, we have nominal and real stochastic discount factors that exist. So the nominal stochastic discount factor, there's a nominal short rate and some shocks and some risk premia. Here, this gamma. And then we also have a real stochastic discount factor and a real short rate and shocks to the same. In the general framework, you can just, they're affected by the same shocks. And then zero coupon bond prices, that's just the expectation of the ratios of these nominal and real stochastic discount factors. And the nominal discount factor, that's the net present value of in T0 dollars of $1 paid at time T. And the real stochastic discount factor, that's net present value in T0 dollars of a goods basket at time T. And because of that, the ratio between the two, the price defines a price level or price index as the number of dollars at time T per goods basket at time T. So that's at a very high level what's going on here. And then all we need to do is set up models for these nominal and real short rates, and then we can kind of use this very general standard finance framework. So Carriero and co-authors, they are studying UK data and nominal and real yield in the UK, and they set up a 5-factor arbitrage-free model of nominal real yields that's built around these arbitrage-free Nielsen-Siegel models I developed back in 2011, Frank Diebold and Glenn Rudebush. So this G5, it's a 5-factor model, it's Gaussian, so G5 model. It has nominal level, slope, and curvature, and on the real side, it has a real level and slope factor. And the instantaneous nominal short rate, well, that's the sum of the level and slope, and that's the assumption you have to make to be within these AFNS models. And you want an AFNS model on the real side as well, so you make the real short rate is also the sum of the real level and slope factors. And then if you assume that the risk neutral, the dynamics you are going to use to price the bonds, if you assume that the mean reversion under the Q measure has this particular structure and where we can fix these mean parameters here, you can fix those at 0 without loss of generality. That's back in this 2011 paper, we show that. Then do the bond math, and voila, you'll get a nominal zero coupon yield curve that has the classic Nielsen-Siegel level, slope, and curvature. And then there's a yield adjustment term, which makes the model arbitrage-free. So that's a contribution of that 2011 paper to show that you can get Nielsen-Siegel yield curves that are arbitrage-free. You just get this deterministic yield adjustment term. And then we preserve a similar Nielsen-Siegel level and slope structure on the real side. And these are our frictionless nominal and real yield curves. So these are the yield curves that would prevail in this alternative unobserved world where there are no frictions to trading of the nominal and real bonds in our sample. But that's not the world, the actual data that has liquidity risk reflected in the prices. So in joint work with Martin Andreasen and Simon Riddell, another former RA of mine, and Martin Andreasen is professor at Aarhus University back in Denmark. In our 2021 paper, we say, here's a way to account for liquidity risk. Take your standard model with a short rate RT, and then instead of discounting the cash flow from each bond using that as you would normally do, you need to discount the cash flow from bond I with this augmented discount function where there's a liquidity factor, a beta I scaling on the liquidity factor, and then a decay function in here exponential minus lambda I of the time since TI0. TI0, that's the date the bond was issued. That means that when you do the discounting of the bond, the time since issuance, T minus TI0, that's going to be a component in your bond pricing formula. And the time since issuance, that's going to be a proxy for a bond is issued, starts trading in the markets. As time passes, a greater and greater fraction of that specific bond series will get locked up in buy and hold investors' portfolio. And they just buy it and put it in their portfolio, and then they walk away. They never come back to the market. And therefore, it's not available for trading. Investors are aware of that, and they form expectations about that when they're trading. Whether they observe numbers on how much of a given bond series is actually available for trading, that doesn't matter. What's key here is that they form expectations about that, and they use those expectations when they trade. And because of that, the bond prices become a function both of the standard remaining time to maturity and the time since issuance. And clearly, this story I've just told you, a bond gets issued, start trading, that's any bond. So this applies to any market, and also you start from RT, so you can do this with any existing model. So whatever is your favorite model you have on the shelf, you can augment it in this way. But because of who I am, I'm obviously an arbitrage-free Nielsen-Siegel kind of guy, because I invented that model framework, and it works. I'm going to take this to the model I just showed you. So we take the G5 model and we augment it with our two liquidity risk factors, and then we call that the G7 model with XN and XR, because we're going to have a liquidity factor for the nominal bonds and a liquidity factor for the real bonds. And then we're going to, oh, sorry, I guess there's a missing zero here. We are going to stick those in. So we have the top four factors here. They affect the nominal bonds, and the bottom three factors, they affect the real bonds. And then whenever you do something new, keep your life simple. So what's the simplest I can do here? That's to make these XN and XR factors independent Vasicek processes under the Q measure. You could do something more complicated, but this is the simplest way to implement this as a starting point, and then that's and it works, and it gives reasonable results. So I haven't had reason to explore complicating this structure at all. So that's on the basically the pricing, and then again you can do the pricing, and we have appendices with that in various papers. Bottom line is, if you take the nominal and real bond prices we observe, they are coupon bonds with a coupon C that's paid semi-annually. So on the nominal side, you take those coupons and the principal, and you discount that with this augmented or modified nominal discount function I showed you. And on the real side, you discount the coupons and the principal with the real modified short rate. And then lastly, and then you just use these bond price formulas in the Kalman filter. And then there's one little omission here, that the lag in the UDI bonus inflation indexation, I don't take that into account, but there's some papers out there like Christensen and Juan, their 2013 paper, that have done that, and the adjustment is just typically a few basis points. So it's really not, it doesn't seem to be worthwhile to complicate what is already a complicated model here further with that minor refinement. So that's all on the pricing side. The measurement equations to do the Kalman filter, well, we need the real world dynamics. So go to Gregory Duffy and his JF 2002 paper with the essential affine risk premium specification. that means that this gamma that was in the original model slide, that's a function of the state variables. In our case, it's a 7-factor model. So gamma 0, that's a vector of 7 elements, and gamma 1 is a 7x7 matrix. And if you tag that on, it means that we have complete freedom under the objective P measure to pick the mean reversion rate and the mean vector any way we want, separately from the Q dynamics that are used to fit the bond prices. And this is the transition equation in the Kalman filter estimation. And then lastly, in terms of the measurement equations, we are observing these raw bond prices. In the paper with Martin Andreasen and Simon Riedel, we show that if you divide the bond prices with duration, you get a measurement equation that's essentially affine. It would be like, it makes it very close to equivalent to observing zero coupon yields. And these durations, you calculate those from your observed bond price data before you start the model estimation. So they're fixed before the estimation. So the only thing you are fitting is you have the observed bond price and then your fitted bond price. And then you can do the Kalman filtering. But these measurement equations, they are nonlinear. So we do extended Kalman filtering, basically following Don Kim and Ken Singleton from their 2012 paper. And then you need to, there's one identification you need to do on both the nominal and the real side. You need to pick a bond. So we pick bond number 10 for the bonus, this 2038 bond with 8.5% coupon rate. That has a unit loading on the bonus liquidity factor. And then on the real side, it's UDI bonus number 5, this 2035 bond with a 4.5% real coupon that has a unit loading on the UDI bonus liquidity factor. But there's really an innocent econometric. You need to have unit loading on one of these bonds. And then we also, to get given all these parameters in terms of the P dynamics, and to get the right persistence, we follow the recommendations of Don Kim and Orphanidis from their 2012 JFQA paper, that to include information from surveys. So we include the inflation forecast from the consensus forecast survey to get what Don Kim would call the appropriate persistence of the state variables in our model. And then lastly, we assume stationarity so that we can start the Kalman filtering at the unconditional mean of the state variables. So that's the measurement equation, the transition equation, and the nonlinear extended Kalman filtering and how we do it. But from there, everything is standard. So if there are no questions about the model structure, we can let the games begin. What comes out of this beast? And let's start with these estimated liquidity premia. How do we get those? Well, you estimate the model, and then in the model, you will have the fitted bond prices. And you can convert, so let's call those P hat, and you can convert those into yield to maturity. Let's call those Y hat. And then you can go into the model and then say, I want the frictionless. So look at that G5 model where I've dropped the liquidity factors. And I'm just looking at that G5, the frictionless model. And using the estimated parameters and filtered state variables, you can take that model and discount the cash flow of each bond and then ask, okay, hey, what's the frictionless price of this bond? And that G5 model will give you a number, and we call that P tilde. And you can take that and also convert into yield to maturity and get a yield that we call Y tilde. And then the difference between these two, the yield from basically fitting the observed data, Y hat, well, the observed data, the bond price is depressed by these liquidity premium. A low bond price, that's a high bond yield. That's going to be a high yield number. And then the frictionless, where prices are not depressed or discounted by these liquidity premium, that's going to be a slightly higher bond price, and a higher price, that's a lower yield. So this Y tilde, you should think of that as a lower number, and then the difference between those two should be a positive number, and we call that psi I. So the model provides estimate at each point in time of the liquidity premium for each bond. So I have estimates of the liquidity premium series for all the bonds in the sample. That's what comes out of the estimation and measured this way. And then how to show that? Well, take the bonus, the estimated liquidity premium calculated as I just described, and then take the average of the bonds in your sample at each point in time. Then you get what we call the average bonus liquidity premium, and that's this black line that has been trending up basically in tandem with the increase of the foreign presence in the, and that's what we find in the first 2021 paper. We established that this upward trend in the liquidity premium, that's driven by the increased foreign participation in the bonus market, because what happens when 60% of your market becomes owned by foreigners? You know, they read their Goldman Sachs notes and whatever, and now it's time to rotate out of Mexican into Brazilian. So that significantly increases, the flight risk, that some of these foreign guys will just turn around and move hundreds of millions, if not billions of dollars out of the Mexican market. So investors are aware of this, and they charge a higher liquidity premium for being exposed to that higher flight risk. So that's what we document and why that paper was published. But again, so the UDI bonus market, no foreigners there. So liquidity risk, very different there. So calculate the liquidity premium for all the UDI bonus in your sample and take the average, you get the gray line, and which spiked up here and dropped down and has a different dynamic profile than the bonus liquidity premium, and the correlation is basically zero. So the liquidity risk in these two markets is very different. You need a liquidity factor on both sides to account to see this and account for this. So you need the full 7-factor model to do this and to see this. So that's the liquidity premium we get from the model. And now let me turn to this break-even decomposition. I have a paper back from 2010 with Jose Lopez and Glenn Rudebush. And if you dive into that, you can see formulas there that break-even inflation, which is defined as the difference between nominal and real yields of the same maturity tau. Well, that's equal to the expected inflation at the same tau horizon, and then a residual inflation risk premium. And the bond, those formulas and that decomposition, the calculations show that, this expected inflation, well, that's actually -1 over tau of the expectation of this ratio of the price index. And it turns out that that's actually this exponential minus integral of the difference between the nominal and the real short rates within our model. And I should note that this is the frictionless dynamics. So this is, so you need to, again, drop the liquidity factors, go zoom in on this G5 frictionless model, and then you use these formulas here, and you get the expected inflation and the residual inflation risk premium that turns out to be a function of this covariance between the real stochastic discount factor and the price level. And the key point to observe here is that this is all functions of the P dynamics. So what you really care about, if you want to know about expected inflation and the inflation risk premium, is the P dynamics of the factors in your model. So doing that, we circle back to the chart I showed you, where the raw data, the 5-year fitted break-even, that was this gray line. We have the liquidity premium, and here the net liquidity premium or pollution of the break-even, that's the yellow area. Take that out, and you are left with this 5-year frictionless break-even or adjusted break-even. And then the model allows you to break that down into the expected inflation with the red line and the residual inflation risk premium, the green line. And is the model on track and sensible? Yes, that's where we have the 5-year survey forecast in there. And you can also see the realized year-over-year CPI inflation. That these long-term inflation expectations, they seem to be stable around the inflation target. And even though it's 5-year expected inflation, so expected inflation at the long term, it is mildly positively correlated with the CPI realizations, which seems to be a reasonable property of that series. What else can we do to validate the model? Well, there is staff at the Bank of Mexico that have made models of using yield data and other components. Aguilar, RKS, and co-authors 2016 is an example of that. They were kind enough to share their data. So the 5-year expected inflation from their model, that's the gray line here, and then we can compare that to our the black line we get from our model. And one thing to note is that their expected inflation is extremely stable. I would say too stable for my taste, but both series are basically fluctuating around the 3% inflation target relatively closely. So at a high level, qualitatively, the takeaway you would get from both models would seem to be very similar. And for the same reason, the estimated inflation risk premium here they only report at the 10-year horizon. So, but I can calculate anything from my model. I don't have to focus on the 5-year. So I could spit out the 10-year inflation risk premium for comparison. So we are comparing apples to apples, and you can see those two series are highly positively correlated and operate at the same level. So that gives us confidence in our inflation risk premium estimate. What else can you do to kind of get a sense of, is the model generating appropriate inflation dynamics? Well, you can compare the numbers to the inflation forecast from the consensus forecast survey, and then generate matching because we had fitted break even and a random walk assumption, and then take those forecasts from May 2009 to November 2019, and then compare that with the actual outcomes, and look at the mean forecast error, the root mean square forecast error, and the mean absolute error. And you can see the model is better than the random walk. The model is better than break even. So the model adds value over break even and the random walk by accounting appropriately for the liquidity and the inflation risk premia. To beat the consensus forecast panel itself, that would obviously be hard. I mean, that's professional economists using all available information to delivered their best possible forecast, but the model is pretty close. So we take this as a comforting sign that the model is generating realistic inflation dynamics. Now, more to the question of, are long-term inflation expectations anchored in Mexico? Alicia Grishchenko from the Federal Reserve Board and co-authors 2019, they look at the probability of various inflation outcomes. So inspired by them, we calculate the probability of the five-year expected inflation staying within the Bank of Mexico's tolerance band, which is plus minus 1% around the target. So remaining in the 2 to 4% range. And we calculate that at a 1-year horizon and at a 3-year horizon. And one thing you see is that as you extend the horizon, you're looking at the probability decline, because inflation and inflation expectations is somewhat volatile in Mexico, and definitely more volatile than what Grishchenko and co-authors they found for the Euro area and for the United States. So we don't get the 80–90% probabilities that they report for the Euro area or for the US, but we still get nice, relatively high probabilities of remaining within the tolerance band. And lastly, we can use the dynamics, the estimated factor dynamics, to simulate 10,000 paths and look at over the next 3 years, and then along each path calculate whatever outcome you want to look at. Here I'm interested in the 5-year expected inflation. And if you do that, you get a median projection, that's the solid blue line, and you get a 90% confidence band indicated by the dashed blue lines. And that's fairly wide because, inflation and disinflation expectations, yes, they are more volatile than you would probably see in the Euro area or in the US. So you get a potential range of relatively wide outcomes, and that's also why we had these declining probabilities as you extend the horizon over which you look at the anchoring. But importantly, I have updated the exercise or the model and re-estimated every month, and then gone in and calculated, well, what was the 5-year expected inflation? And do that every month up till October of 2022. So these are what are the subsequent realizations. And yes, the pandemic hit, and guess what? Expected inflation dropped, and then we got a little bit into the pandemic and things bounced back, and then they have basically remained stable since then through the reopening and through Russia's war in Ukraine, and remained relatively close to the median projection. So this is my key evidence that despite the sharp and unexpected increases in inflation, both in Mexico and elsewhere, long-term inflation expectations in Mexico, they appear to remain well anchored, fairly close to the Bank of Mexico's 3% inflation target, despite all the stuff that has been going on the last 18 months. So let's get towards the end here. These inflation risk premia, and what can we say about those? Let me just be specific here. We take this green line, the 5-year inflation risk premium, and then we explore up to, I think, 22 different explanatory variables, and what are the factors that seem to be driving inflation risk in Mexico. The foreign share of bonus holdings, that's a key explanatory variable, consistent with our 2021 paper. The VIX is a key factor. The WTI oil price is a key factor. When the VIX goes up, inflation risk premia goes up in Mexico. When the oil price goes up and inflation goes up, as a consequence, inflation risk premia go up. When the 10-year US Treasury yield go up, inflation risk premia in Mexico go up. And when foreign holdings increase, the inflation risk premium goes down. So there's so the liquidity premium goes up because there's an increased risk of flight out of the market, but the underlying fundamental inflation risk premium, that gets a downward pressure when the foreign share goes up in the Mexican bonus market. So that's what seems to be the main drivers of inflation risk premia in Mexico. And then how can we validate that model? Well, take this preferred regression model, and then what I'm showing you here is the black line is this observed inflation risk premium through the end of 2019, and the gray line is the fitted series from our preferred regression model I just showed you with all four factors: the foreign share, the VIX, the WTI, and the 10-year Treasury yield in the sample. And then again, I have this updated exercise. Each month, we estimate the model with the updated data and then calculate what were the inflation risk premium, similar to what I did with the projection exercise. And I should note that we do this exercise in two ways. One, where we update both the bond data and with the survey. So basically estimate the model like we do in the baseline. And then I also do an update without updating the survey. So yes, there's survey information in the 2009 to 2019 sample, but then past 2019, there's no new survey data included in the models. If you don't see two lines here, it's because those two estimates are right on top of each other. So these updated results are not driven by the survey information. It's driven by what's in the yield data. Then is our regression model on track? Well, fix the regression coefficients at the value we got from the baseline, the 2019 baseline sample. So these values here, and then update your explanatory variables and use the regression model to, well, what would be the predicted inflation risk premium? And as you can see, it captures this upward trend that has actually happened very closely, almost only somewhat less accurately than the in-sample fit we had already. And importantly, yes, inflation risk has spiked up more, but that, I mean, that's not surprising. That should almost be expected because these upside unexpected shocks to global inflation we have experienced the last 18 months, yes, that has made inflation risk premia go up more than our regression model expected. If it's almost like if this was not the result, then there would be something wrong. So I take this as confirmation that our model is on track. It's capturing the key drivers of inflation risk in Mexico. And yes, shocks have been larger and more persistent than our regression model could have anticipated, and that is not surprising. Lastly, how does a Mexican inflation risk premium stack up to other in an international comparison? Well, I have models of Canadian data with Patrick Schulz and Glenn Rudebush is 21, and then obviously I have US estimates from the work with Martin Andreasen and Simon Riedel, our 2021 paper. So that's the red and the blue line, and then the green line is the estimate from Mexico. And yes, inflation risk is a notch higher in Mexico and somewhat more volatile, but that seems reasonable again, given that inflation itself is higher and more volatile in Mexico compared to the statistics you will find in the US and in Canada. So let me conclude. Close to being on time here, we assess inflation risk and the anchoring of inflation expectations in Mexico, which is an important emerging economy. And to achieve that, we introduced this novel term structure, 7-factor term structure models, nominal and real yields, that accounts for liquidity premia, both in nominal bonds and real bonds, and which turn out to be sizable and time varying. I showed you the series. And then while Mexican inflation risk premia are volatile, and with these persistent trends, the long-term inflation expectations in Mexico appear to be stable and have remained close to the Bank of Mexico's inflation target. And the model projections we do, leveraging the model's estimated dynamics, they point in the same direction. So we basically end up with a conclusion very similar to what De Pruder and co-authors found in their 2014 paper, that inflation expectations were well anchored during our main sample period, and the updates we have done up till the most recent suggest that that continues to be the case.